Hello and welcome to the channel. Today's video is about Worldcom fraud. The Worldcom fraud came to light in the summer of 2002 at Worldcom, the USA's second largest long-distance telecom company at the time. The fraud was uncovered in June 2002 when the company's internal audit unit discovered over $3.8 billion of fraudulent balance sheet entries. Eventually, Worldcom was forced to admit that it had overstated its assets by over $11 billion. At the time, it was the largest accounting fraud in American history. In December 2000, Worldcom financial analyst Kim Emig was told to allocate labor for capital projects in Worldcom's Network Systems division as an expense rather than book it as a capital project. By Emig's estimate, the order would have affected at least $35 million in capital spending. Believing that he was being asked to commit tax fraud, Emig pressed his concerns up the chain of command, notifying an assistant to Worldcom Chief Operating Officer Ron Beaumont. Within 24 hours, it was decided not to implement the directive. However, Emig was reprimanded by his immediate superiors and subsequently laid off in March 2001. Emig said that he had expressed concerns about MCI's spending habits for years. The Fort Worth Weekly article was eventually read by Glenn Smith, an internal audit manager. After examining it, he suggested to his boss, Cynthia Cooper, that she should start that year's scheduled capital expenditure audit a few months early. Cooper agreed, and the audit began in late May. Corporate Finance Director Sanjeev Sethi explained the differing amounts in two capital spending expenditures related to prepaid capacity. No one in the room had ever heard that term before. When pressed for an explanation, Sethi said that he did not know what the term meant, even though his division approved capital spending requests. Head of Property Accounting was asked about the term. But he was not familiar with it either, even though he had made several entries about prepaid capacity in Worldcom's computerized accounting system. Cooper and Smith asked Senior Associate Eugene Morse to peruse the accounting system for any references to prepaid capacity. Morse was eventually able to find one and trace it through the system. However, the amounts were bouncing between accounts in an unusual manner, resulting in a large round amount moving from Worldcom's income statement to its balance sheet. Eventually, Morse found more entries about prepaid capacity. Large amounts had been transferred from the income statement to the balance sheet from the third quarter of 2001 to the first quarter of 2002. Soon afterward, Chief Financial Officer Scott Sullivan asked the internal audit team to walk him through recently completed audits. When Smith's turn came, Cooper asked about the prepaid capacity entries. Sullivan claimed that it referred to costs related to SONET rings and lines that were either not being used at all or were seeing low usage. He claimed those costs were being capitalized because the costs associated with line leases were fixed even as revenue dropped. He planned to take a restructuring charge in the second quarter of 2002, after which Worldcom would allocate these costs between restructuring charges and expenses. He asked Cooper to postpone the capital expenditure audit until the third quarter, heightening Cooper's suspicions. Cooper decided not to wait to discuss the matter with Sullivan. She decided to ask the accountants who made those entries to provide support for them herself. Beforehand, she asked Kenny Avery, who had been Anderson's lead partner on the Worldcom account before KPMG took over, if he knew about prepaid capacity. Cooper and Smith then questioned Betty Vinson, the accounting director who made the entries. To their surprise, Vinson admitted she had made the entries without knowing what they were for or seeing support for them. She had done so at the direction of Myers and General Accounting Director Buford Yates. When Cooper and Smith spoke with Yates, he admitted that he did not know what prepaid capacity was. Yates also claimed that accountants reporting to him booked entries at Myers' direction. Finally, the internal auditors spoke with Myers. He admitted that there was no support for the entries. In fact, they had been booked based on what we thought the margins should be, and there were no accounting standards that supported them. He admitted that the entries should have never been made, but it was difficult to stop once they started. Bobbitt called an audit committee meeting for June 20th. By this time, Cooper's team had discovered over $3 billion in questionable transfers from line cost expense accounts to assets from 2001 to 2002. At the meeting, Farrell stated that there was nothing in GAAP that would allow those entries. Sullivan claimed that Worldcom had invested in expanding the telecom network from 1999 onward, but the anticipated expansion in customer usage never occurred. He argued that the entries were justified on the basis of the matching principle, which allowed costs to be booked as expenses, so they align with any future benefit accrued from an asset. He claimed that Myers could provide support for the entries. The committee gave him until the following Monday to get support. Over the weekend, Cooper and her team discovered several more suspicious prepaid capacity entries. All told, the internal audit unit had discovered a total of 49 prepaid capacity entries detailing $3.8 billion. Several of them were keyed in on explicit directions from Sullivan and Myers under the line SS entry. While some of the suspicious entries were made by directors and managers, others were made by lower-level accountants who didn't understand the seriousness of what they were doing. The audit committee asked KPMG to conduct its own review. KPMG discovered that Sullivan had moved system costs across a number of property accounts, allowing them to be booked as capital expenditures. The expenses were spread out so they weren't initially obvious. When KPMG asked Anderson's former Worldcom engagement team about the entries, the Anderson accountants said they would have never approved of the entries had they known about them. Sullivan was asked to present a written explanation for his actions by Mondays. At audit committee meeting that Monday, Sullivan presented a white paper explaining his reasoning. The audit committee and KPMG were not persuaded. They concluded that the amounts were transferred with the sole purpose of meeting Wall Street targets, and the only acceptable remedy was to restate corporate earnings for all of 2001 and the first quarter of 2002. Anderson withdrew its audit opinion for 2001, and the board demanded Sullivan and Myers' resignations. On June 25, after the amount of the illicit entries was confirmed, the board accepted Myers' resignation and fired Sullivan when he refused to resign. On the same day, Worldcom executives briefed the SEC, revealing that it would have to restate its earnings for the previous 5 quarters. Later that day, Worldcom publicly admitted that it had overstated its cash flow by over $3.8 billion over the previous 5 quarters. The disclosure came at a particularly bad time for Worldcom. Even before the scandal broke, its credit had been reduced to junk status, and its stock had lost over 94% of its value. It had been facing a separate SEC investigation into its accounting that had started earlier in the year, and was laboring under $30 billion in debt. Amid rumors of bankruptcy, Worldcom said it would lay off 17,000 employees. The SEC filed civil fraud charges against Worldcom on June 26, speculating that Worldcom had engaged in a concerted effort to manipulate its earnings. Additionally, it claimed that the scheme had been directed and approved by senior management. In 2005, Ebers was found guilty by a jury for fraud, conspiracy, and filing false documents with regulators. He was subsequently sentenced to 25 years in prison. However, he was released in December 2019 due to declining health. The Sarbanes-Oxley Act is said to have passed due to scandals such as Worldcom and Enron. In the aftermath, Worldcom left a stain on the reputation of accounting firms, investment banks, and credit rating agencies that had never quite been removed. The Worldcom fraud affected the company and led to its downfall. Worldcom Incorporated collapsed and went into bankruptcy in 2002.